Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Chicago wheat. Okay, so there has and is a lot going on here in a relatively short amount of time. The top side has been dominated in recent times, despite a brief breach higher 5 weeks ago, and again this week, by the combination of the slowly declining, flatlining gold long moving average, currently at 562 even, and the flat dark blue trend line, currently 570 and a quarter, of which I will deal with shortly. I said 6 weeks ago, and I quote, "Please just bear in mind that beyond these we have some clean air up until the congestion at 588 and the March 2021 low at 592. And that's the end of the quote. As we saw that happen actually 5 weeks ago with that breach, sharp run up, then getting capped by the congestion at 588 and the March 21 low at 592 and a quarter, followed by an equally sharp drop later. I also added 5 weeks ago, and I quote, "A new pattern has emerged and seems to have taken over the running of this market. It's not a great looking pattern, but it nevertheless still there and seems to be dominating the action. It is the mid-March to late June reverse head and shoulders pattern with that previously mentioned flatlining dark blue neckline. Now there's a lot going on in this pattern, but I would draw your attention to one feature, and that is the mid-May early double top pattern. Well, it failed, and now should be considered not only as part of a second shoulder." That's the end of the quote. Now, I also spoke of this possible pattern during the prior week, so 6 weeks ago, and there were some elements back then that I think you should still consider, and I quote, "It is to look at the whole mid-March of the action as a possible reverse head and shoulder pattern. Typically this is seen as a bullish reversal pattern, but head and shoulders continuation patterns also exist. So I'll delay any opinion on which one until I have some further data. The neckline for this, well, I'd use the crucial gold long moving average right now until we see further developments," end of quote. As you can see, I finessed the gold neckline into a separate solid dark blue neckline, and I did have 5 weeks ago enough of a move higher, admittedly through some empty space, to lay out some potential targets topside. Thus a primary target X would be in the 616 area, whilst a secondary harder to reach target X1 would be in the 635 area. I finally added 5 weeks ago onto this, and I quote, "I'll now watch and see if the pattern performs as a reverse head and shoulders pattern or not," end of quote. Well, this head and shoulders pattern as a bullish reversal has not performed, as that same old gold long moving average and the dark blue neckline overhead have capped prices once again. However, we also saw once more the impact of the purple neckline extension, which is currently at 532 and 3/4, and that had on the downside of the market supporting prices from below as recently as late June and again early last week. All this being said, I'll for now still keep targets X and X1 topside on my daily chart, but with a notice of potential retirement to them. And in the meantime, I've been looking for something else that might show a different point of view to this market. And this is where the so far unhighlighted mid-February to mid-June bearish Andrews pitchfork comes in. It is early yet on this one, but this week has been a revelation with the top of the market capped by the upper tight, currently at 570 even. This pattern might prove to be a better view of what is happening here than the reverse head and shoulders idea. For this pattern, right now we are still just underneath the overhead upper time and with the middle time below, currently at 513 and a quarter. Please continue to keep an eye on this one as it is becoming increasingly useful. Chicago corn. 8 weeks ago I drew a mid-February to mid-April bearish Andrews pitchfork, which, whilst not being exact, showed for quite a while the bearish angle of attack of this market. However, the upper time had 7 weeks ago been finally broken. Now, I still keep this broken pitchfork on my daily chart for a reason, now past, but still for a reason, which I will explain. I originally chose this steeper bearish Andrews pitchfork over the shallower bearish shift pitchfork with the same move, as I thought it gave a more suitable representation of the way the market was moving lower, which it did. However, and it's important however, and I quote from 10 weeks ago when I said, however, that being said, the Times next crossover this coming Monday, the 19th of May. So watch out for one or more of the following then. A change in trend, a reinforcement of a trend, volatility. Coincidentally, after changeover this week, prices are now testing the 50% absolute Fibonacci line at 425. So it's worth being cautious right now. End of quote. The caution back then was well rewarded, as on Monday the 19th we had a combined key reversal up, if only just, plus a bullish engulfing pattern and a bullish opening Mariposa, leading to prices rising up in the early part of that week, that's 9 weeks ago, filling in the changeover gap and thus fully justifying the earlier time crossover warning I'd given. I finally drew the shallower bearish shift pitchfork on the daily chart with the same move as the bearish Andrews one, as the market transitioned from the steeper Andrews to the shallower bearish shift pitchfork. Thus, right now we are just underneath the overhead middle time, it's currently at 422 even. Now, before I review the very recent market action, there is a significant event I would now like to discuss, and one I highlighted 6 weeks ago on a subsequent occasion at a biofuels conference where I was speaking at in Brussels, Belgium, and I quote, "This ties in with the early crossover of tines back on the 19th of May. You see, the next crossover, indeed the last and possibly least powerful crossover, will happen on the 24th of June. I've highlighted this with a bright red circle just above this picture of me on the screen. Be wary then, just in case we see a possible change in trend or a reinforcement of a trend, and of course volatility, or even all three of these all at the same time. So caution." And that's the end of the quote. Well, as you can see by the action on the 24th of June, 4 weeks ago, we had a break lower to new lows not seen since September last year. And it was only congestion at 403 plus the just below November 2020 low at 397, plus importantly the lower time, which is currently at 386.25, of the bearish shift pitchfork that halted and turned prices back up, thus fulfilling what I cautioned about so many weeks earlier about that day. The subsequent recovery has not been an easy one, with an artificial weekly key reversal up due to changeover, and prices have ended up last week and this running along the underside of the middle time, and thus just underneath the green descending short medium moving average, currently 422 3/4. So looking below, we have the nearby December 2020 low at 414, which ties in with the low of late November last year. We have further support below of dubious strength that is fairly evenly spaced out at 409, 403 until the November 2020 low at 397 and this year's low at 391.25. There is limited support below this, realistically at 386.5, then the August 24 and 24 low at 385 before a low, not monthly lows, but just a low from late 2020 at 369. After this, well, we have the bottom of my daily chart, the old 2006, so 19-year-old to date, 2006 to date uptrend, currently at 348 3/4. There's one other feature I would like to point out. It is a lagging indicator, but one nevertheless. We had a dead cross 2 weeks ago of the medium moving average, currently at 445, moving down through the shallower declining long moving average, currently 452.5. Kansas City wheat. The major pattern here continues to be the dark blue February to March bearish shift pitchfork. It was a few weeks ago not a great looking one, having both the lower tie, currently at 471.25, and the upper tie, currently 566.25, pierced but not broken. Thus both ties continue to play a more significant role these days in showing the bearish angle of attack, despite the recent changeover gap. Interestingly, in recent weeks, a new pattern emerged, though this has also been breached, though not as yet broken, whilst at the same time some older resistances and I suppose supports as well have influenced the market. The new pattern started out as one thing and developed into something else. You see, I said 5 weeks ago, and I quote, a short purple upper trend line of the interesting mid-May to date bullish half hesitation. This pattern is interesting as it started out as a possible double top pattern, quite good looking pattern, but then became a small expanding wedge pattern, end of quote. I've chosen for now not to extend the purple trend lines on this, as I think the dark blue bearish shift pitchfork is the more dominant pattern. I would not wish to take anything away from it. Meanwhile, looking at the older resistances, well, they consist of the combination of the bright green lower trend line extension, currently at 563.5, of the November 23 to April 24 descending triangle, plus the declining mauve medium moving average, currently 554.75, and the gold long moving average, currently at 566.5. These, in reality, did not stop the market's rise, but they sure eroded the move higher 3 weeks ago, enough for prices to turn lower and seem to be doing the same again this week. At the same time, the support of the 38.2% absolute Fibonacci line at 532.5 and the low of August 24 at 527, which was in turn created by that same 38.2% absolute Fibonacci line, managed to hold up prices below over June and into July, and along with the middle time, currently at 518.75, erode the bearishness we saw earlier in July. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.